All right, let's dive into an explainer on a strategy that's all about bringing a little bit of sanity to the, let's face it, pretty wild and often stomach-churning world of crypto investing.
You've been there, right? You see a coin just absolutely taking off, and that little voice in your head starts screaming, you have to get in right now before you miss everything. We've all felt it. That FOMO is a powerful, powerful feeling.
And then, of course, there's the flip side. The market suddenly turns blood red. It's one of those crashes that makes your heart sink, and every single instinct you have is telling you to just sell it all, just to make the pain stop. It's pure gut-wrenching panic.
Well, this whole roller coaster, swinging from FOMO to fear and back again, that is the trap of trying to time the market, trying to perfectly nail the absolute bottom to buy and the absolute top to sell. It's a game that, frankly, is almost impossible to win.
But what if there was another way? A path that lets you step off that emotional roller coaster. So let's talk about a strategy for sanity. It's called dollar cost averaging.
So what is it? It's actually beautiful in its simplicity. Dollar cost averaging, or DCA for short, just means you invest a fixed amount of money, let's say $100, at a regular interval, like every single Monday, no matter what the price is doing. The key here is fixed amount and regular intervals. That's it. And the framework to get started is just as simple. Step 1, you pick the asset you actually believe in for the long run. Step 2, you decide on an amount you can comfortably invest. And step 3, you stick to your schedule. See, it's a methodical routine, not some kind of high-stakes gamble.
Okay, so how does such a simple discipline manage to tame the absolute beast that is crypto volatility? Well, the logic behind it is pretty elegant, so let's break it down.
The real magic of DCA is that it smooths everything out. Instead of making one giant bet on one single price, you end up buying at lots of different prices over time. And what that does is it naturally brings your average cost way down.
Now, this is where it really clicks. Let's look at the math. In January, your $100 gets you 2 coins because the price is $50. But then, in February, the price crashes down to $25. This is where DCA becomes your best friend. Your same $100 now buys you 4 coins. Then in March, the price rips back up to $100, so you only get 1 coin. So what's the result? You've put in $300, but you got 7 coins. Your average cost per coin is now under $43.
And that right there is the whole point. With DCA, those big price dips, they stop being scary. They actually become opportunities because you're automatically buying more of the asset when it's on sale. Volatility isn't a threat anymore. It's actually working for you.
But this goes way beyond the math. There's a really profound human element to all of this. Let's get into the power of putting your plan on autopilot and the huge advantages that come with it. So here we have a tale of 2 investors. On one side, you've got the market timer. They're constantly reacting. They're driven by emotion. They're basically just guessing. The result, a ton of stress. On the other side, you have the DCA investor. They're driven by discipline. Their process is a calm, methodical routine. And the result is peace of mind in a market that literally never sleeps. The source material puts it perfectly. It says that DCA is a powerful antidote to those destructive emotional biases, fear, and greed that so often lead us to make really bad decisions.
Essentially, you can think of DCA as your psychological shield. It takes the guesswork and the emotion out of the picture. It helps you ignore all that distracting short-term noise and keeps you focused on your long-term plan. Now, before you run off and set this all up, it is absolutely critical to understand that this is not a get-rich-quick scheme. There are 2 golden rules that really determine if this strategy is going to work for you. And let's be crystal clear on this. DCA is not a magic bullet. It's an incredibly powerful tool for sure, but its success completely depends on you making 2 fundamental commitments. First things first, and this is non-negotiable, you absolutely must have long-term conviction in whatever asset you're buying. DCA is a strategy for accumulating. It only works if you genuinely believe that over the long haul, the value of what you're buying is going to go up. I mean, if it's heading to zero, all you're doing is buying the dip over and over again on your way down.
And second, you have to commit through all the market cycles, the good, the bad, and the ugly. The temptation to just stop buying when we're in a scary bear market is huge, but that is precisely when the strategy is working its magic, when you're getting the most bang for your buck. If you abandon the plan then, you defeat the whole purpose.
So this really brings us to the core philosophy here. It's about shifting your mindset from trying to be some kind of market wizard to just being a disciplined, consistent accumulator. So try not to think of dollar cost averaging as just a simple buying tactic. It's so much bigger than that. It's a full-on risk management framework, and, just as important, it's a powerful psychological tool to help you invest for the long term.
So what are the big takeaways here? Well, DCA prioritizes consistency over the impossible dream of perfect timing. It forces you to focus on long-term value. And, maybe best of all, it makes investing accessible to everybody, not just people with a huge pile of cash to throw in all at once.
And that kind of leaves us with one final thought. What if the real key to successful investing isn't about having a crystal ball and predicting the future? What if it's simply about having the discipline to commit to a solid, unemotional plan, and then just letting time and consistency do all the heavy lifting for you?